Hello and welcome back to Whiteboard Crypto. In this video, we are going to explain what the Genius Act is. If you haven't already, please hit that subscribe button and click like if you find this video helpful. Now let's get started. First off, what is the Genius Act? So Genius stands for the GENIUS Act, and it is a bipartisan bill recently passed by the Senate. It intends to establish a regulatory framework for stablecoins. So what is a stablecoin? A stablecoin is a special kind of cryptocurrency that is supposed to be pegged one-to-one to the US dollar, meaning that each unit of the cryptocurrency should always be worth $1 US. So how does the Genius Act intend to operate, and why are some people concerned about it? Let's dive in. First, federal regulation and licensing. One of the core components of the Genius Act is to provide legitimacy to stablecoins by bringing them under the umbrella of federal government regulation. This contrasts with the current environment where many stablecoins operate in a regulatory gray area. Under the proposed legislation, companies looking to issue stablecoins would need to acquire a license from federal financial regulators, a process similar to how banks are currently regulated. This licensing requirement would apply to a wide range of entities that want to engage in the business of issuing stablecoins, including banks, tech companies, crypto exchanges, and even large retailers like Walmart. Those entities that decide to step into the stablecoin arena will need to demonstrate financial stability and operational resilience before being granted a license. The intention here is to make stablecoins safer and more legitimate by subjecting them to the same level of scrutiny that traditional financial institutions face. However, this move has raised concerns among some quarters about the practical implications and potential drawbacks of such regulation. One of the primary worries revolves around the administrative burden and cost associated with obtaining and maintaining these licenses. For smaller players in the cryptocurrency space, the expenses involved could act as a significant barrier to entry, potentially stifling innovation and limiting competition. Moreover, critics argue that this licensing regime might inadvertently push stablecoin operations offshore, making them harder to monitor and potentially exposing them to greater risks. If the Genius Act were to pass in its current form, these entities would be regulated by federal bodies such as the Federal Reserve, the Fed, the Federal Deposit Insurance Corporation, FDIC, and the Controller of the Currency. Regulators believe that this extensive oversight will ensure that stablecoin issuers maintain adequate reserves to back their digital tokens, and that they comply with strict financial regulations. The hope is that these measures will instill confidence in the stablecoins, making them more appealing to investors and consumers. But why are some economists like Barry Eichengreen worried about the Genius Act? Despite the well-intentioned goals of the Genius Act, some economists like Barry Eichengreen have voiced strong opposition to the bill, citing potential risks and drawbacks that could undermine its intended objectives. Let's start with risk of breaking the buck. While the Genius Act aims to mitigate risks by requiring stablecoin issuers to hold reserve assets equal in value to the stablecoins they issue, Eichengreen remains skeptical. He believes that this one-to-one backing doesn't necessarily guarantee stability, and that the value of stablecoins could still fluctuate, causing them to deviate from their intended dollar peg. This concern is rooted in the observation that even with regulations and reserve requirements, there's no foolproof method to prevent stablecoin values from drifting away from the target. To illustrate this point, Eichengreen references the 2008 global financial crisis when a prominent money market fund, the Reserve Primary Fund, experienced a temporary drop in value, dipping to 97 cents per share. This event, known as breaking the buck, shook investor confidence in money market funds. highlighting the fragility that can occur even in highly regulated environments. Eichengreen uses this example to suggest that similar issues could arise with stablecoins, despite efforts to anchor their value to the dollar. He questions whether the regulatory oversight outlined in the Genius Bill is robust enough to completely eliminate such risks, emphasizing the potential for even minor fluctuations that could erode investor trust. Federal deposit insurance. Another key issue raised by Eichengreen is the lack of federal deposit insurance for stablecoins. Unlike traditional bank deposits, which are typically insured by the Federal Deposit Insurance Corporation (FDIC), stablecoins do not have a similar safety net. Eichengreen argues that without insurance, investors may become overly concerned about the stability of the stablecoin as value and could rush to exchange them for traditional currency if there is a perceived risk or uncertainty. This phenomenon, known as a run on the bank, could cause a sharp decline in the stablecoin as value, triggering further panic and exacerbating market volatility. Eichengreen highlights that such runs are not unheard of in the financial world, having occurred in the past with other types of investments. He emphasizes that the absence of an insurance mechanism in the Genius Act raises the potential for contagion, where fears about one stablecoin could spread to others, creating a broader market instability. Additionally, Eichengreen points out that the absence of federal deposit insurance could lead to calls for government bailouts if stablecoins experience significant downturns, ultimately shifting the burden to taxpayers. This prospect not only raises fairness concerns, but also highlights the potential for moral hazard, where investors take on excessive risk knowing that they might be bailed out. In contrast to the current situation where banks contribute to a pool that covers insured deposits, Eichengreen suggests that stablecoin issuers could make contributions to a separate fund that would step in to stabilize their value if needed. This proposal echoes the system used in the banking industry, where banks pay into a fund that makes depositors whole if a bank fails. By implementing such a mechanism, Eichengreen believes that investor confidence in stablecoins could be bolstered, reducing the likelihood of destabilizing runs. State-level regulation of small stablecoins. While the Genius Act aims to establish a comprehensive regulatory framework for stablecoins at the federal level, there is a provision that permits state governments to license and regulate stablecoins with issuances below $10 billion. Eichengreen views this aspect of the bill with skepticism, arguing that it could create inconsistencies and potential loopholes that undermine the overall goals of stablecoin regulation. He suggests that allowing states to regulate stablecoins could lead to a patchwork of different rules and standards across the country, making it difficult for stablecoin issuers to comply with all regulations. Moreover, Eichengreen raises concerns that states might compete with each other to attract stablecoin businesses by offering more lenient regulations, potentially creating a race to the bottom. He believes that this could undermine the intended safeguards and could allow certain issuers to avoid the stringent oversight present in the federal licensing regime. To address these issues, Eichengreen advocates for the removal of the provision that allows states to regulate stablecoins, emphasizing the need for uniformity and consistency at the federal level. He argues that by centralizing stablecoin regulation, the potential risks and complexities associated with varying state regulations could be avoided. Now, enforcement of Know Your Customer and AML rules. The Genius Act assumes that private companies like Walmart or your favorite tech company will be able to effectively enforce Know Your Customer and anti-money laundering rules. However, Eisenberg-Green questions the ability of these non-financial institutions to meet the rigorous standards required for complete AML compliance. AML rules are designed to prevent illicit activities such as money laundering and terrorist financing, typically involving complex monitoring, REPO, RTING, and verification processes. Eisenberg Green suggests that private entities may not have the necessary expertise or resources to ensure full compliance with these rules, potentially leaving loopholes for illicit transactions to go undetected. Let's summarize the main points we've discussed. So, to sum up, the Genius Act is a new bill passed by the Senate with the aim to regulate stablecoins, but it still has to be approved by the House of Representatives. The act proposes to license stablecoin issuers, including companies and banks, and subject them to regulation by the Fed, FDIC, and the controller of the currency. It also requires stablecoin issuers to hold reserves to back the value of their tokens. However, critics like Barry Eichengreen argue that these measures don't fully mitigate risks. They worry that stablecoins could still lose their peg to the dollar, that the lack of deposit insurance could lead to instability, and that private companies might not effectively enforce anti-money laundering rules. Eichengreen suggests that the House could strengthen the bill by tightening oversight and creating a safety net similar to what banks have. So what do you think about the Genius Act? Do you think it will help to stabilize stablecoins, or are there better ways to achieve this goal? Please let us know your thoughts in the comments section down below. Thank you for watching this video. We hope that you enjoyed it. If you did, please go ahead and hit that like button for more content like this. We release new videos every single week. If you want to stay up to date with everything going on in the cryptocurrency market, make sure to subscribe. See you next time.